After a really strong year, the stock market has fallen for 2 days in a row. And given that we haven't seen a stock market decrease of this magnitude in quite some time, it really feels like the stock market is crashing. So in this video, I'm going to evaluate the reasons for the stock market decrease in the last 2 days. And I'll also answer if this is a buying opportunity for investors looking to buy the dip here. So let's take a look at the details. Hey everyone, I wanted to take a moment to thank the sponsor of this video. Moomoo is a trading platform that allows individuals to buy and sell stocks and other investments. I posted the link to Moomoo in the description below. If you use that link to sign up to Moomoo, it'll help support my channel, but more importantly, you can get special incentives for using my link, including up to extra 10 free stocks. All right, so the primary culprit of the stock market decrease is the unemployment update. The household survey from the Labor Department saying that the unemployment rate rose by 0.2 percentage points to 4.3% in July, and the number of unemployed people increased to 7.2 million. This is higher than a year earlier when the unemployment rate was 3.5% and the number of unemployed people was 5.9 million. So this data from the Labor Department was not good news, and fewer people with jobs means fewer people spending money in the economy, which means less dollars profit for corporations, and that's bad news for the stock market. And that's the reason why the stock market has fallen in the last 2 days. In fact, if we look at the major indices today, the S&P 500 is down by 2.36%, while the Nasdaq is down 2.81%, and the Russell 2000 index is down 3.51%. The stock market decrease has been worldwide, as the Europe, Middle East, and Africa stock market indexes are also down, and Asia Pacific stock market indices are also down. Now, to understand why an increase in unemployment causes the stock market to decrease, I want to share with you these two things here, and that is the valuation multiple and earnings per share. Stock prices are a function of these two things. What earnings per share a company is going to deliver, let's say $2 earnings per share, and what valuation multiple investors are willing to pay for a stock with a $2 in earnings per share. So let's say if the valuation multiple is 20 and the earnings per share is $2, then the stock price will be $40. Now, the unemployment rate impacts the earnings per share, like I discussed a little bit earlier. With fewer people earning dollars, that's fewer dollars they have to go out and spend. And if they're spending fewer dollars, then that means those businesses are not generating sufficient profits or as much profits as they were last year. Also, if they're generating fewer profits, they might proceed to make layoffs, and this decreasing employment could spiral out of control because job losses leads to fewer profits for companies, leads to more job cutting, which leads to fewer profits, etc., and it could feed this negative virtuous cycle. So there's always a concern among stock market investors once unemployment starts to rise that it'll continue rising. Now, one of the benefits of that is, or I shouldn't say one of the benefits of that, but one of the counter forces to that is the central bank in the United States, which increases or decreases interest rates to try and spur economic activity. So now with the unemployment rate rising and economic activity decreasing, the Federal Reserve can decrease interest rates to help spur economic activity. Also, I want to talk about the valuation multiple, which has to do with investor psychology. The multiple that investors are willing to pay fluctuates all the time. And as you might imagine, when the economy is doing well, investors are willing to pay a higher multiple because investors are folks like you and me. And if the economy is doing well and we observe our job prospects doing well, we observe friends and family and colleagues doing well, we see the market doing well and we're more interested in purchasing stocks. The opposite is also true. If we see the economy declining and we keep hearing of layoffs and we hear of friends and family getting laid off, we become more cautious and we're less willing to invest in the stock market, which brings down the valuation multiple. And so these two things tend to work in tandem. When earnings per share are rising, the valuation multiple is also rising because investor sentiment is increasing as economic activity is increasing. And the opposite is also true. When earnings per share are declining, investor sentiment is declining, and the less they're willing to pay as a multiple for the stock. So that's why you have this virtuous cycle that negatively feeds on itself on the way down and positively feeds on itself on the way up. Hiring slowed to 114,000 jobs last month, according to the Wall Street Journal, and the unemployment rate rose to 4.3%, which is the highest level in nearly 3 years, when the economy was still clawing its way back from the pandemic. Stocks fell sharply after the data came out, reflecting investors' renewed worries about an economic slowdown. And if I show you a 3-year chart of the unemployment rate, you can see it bottoming out around January of 2023, and it's steadily been rising since then. Still, an unemployment rate of 4.3% is low by historical standards. It's just that the trend keeps moving higher, and I discussed that negative virtuous cycle where job losses leads to more job losses because the people that are losing their jobs are now not spending money, and then those other companies are now cutting those jobs, etc., etc. And with the consumer price index declining month over month in the most recent update by 0.06%, inflation is less of a concern for the central bank, which now is more likely to cut interest rate to try and increase economic activity, to try and slow down this rate of job loss. And one way the central bank helps increase economic activity by cutting interest rates is to increase purchases of those items that require financing, such as cars. Most people that purchase a car finance with a 5-year loan or a 7-year loan. And if the interest rate is lower, you might be more willing to buy that car because the monthly payment is lower because the interest rate is lower. So in that way, the central bank, by lowering interest rates, helps increase economic activity. And you can see also the initial claims for unemployment insurance have also been steadily rising over the last 6 or 7 months, up to 249,000 of the latest update. Now, another concern is U.S. household debt levels. I have this data going back 10 years, and U.S. household debt is at record highs, 17.69 trillion in U.S. household debt. And that could be a concern because so much purchasing activity happens because people can borrow. Think about how many people you know that would buy a house if they couldn't borrow to buy that house. How many people do you know that would buy a car if they couldn't borrow to buy the car? Borrowing facilitates so much economic activity that when borrowing decreases, then that slows down economic activity so quickly and so violently that it causes significant slowdowns in economic activity. And that's the fear. That's the fear, is that lending activity will contract, and that contraction will cause a sharp economic slowdown. And the lending activity is mostly done through banks, and you can see this here. A survey of the net percentage of banks reporting increased willingness to make consumer installment loans is at near the lowest levels going back. This data goes back all the way to 1990, and you can see here negative 5.3%. This is coming off lows of even closer to negative 30%, meaning that the net percentage of banks that are willing to make loans is decreasing. Banks are pulling back. And the reason banks are pulling back is because banks are looking at this data, people getting unemployed, people getting laid off, the jobless rate increasing. And so banks are concerned that if they make a loan, they're not going to get paid back. So they're contracting. They're not offering as many loans. And if they're not offering as many loans, then macroeconomic activity is surely going to decrease. The good news is that that's moving higher, and it's not trending downward as it was earlier in the year. And so the fears of this contraction from bank lending activity are not as bad as they might have been, let's say, during the great financial crisis when lending activity severely contracted and that caused a major financial crisis. So all that being said, is this a buying opportunity, or should investors panic and sell whatever they have and get out because things are getting worse? I would say I don't see things getting significantly worse from here. I think US consumer balance sheets overall are strong because of all of that stimulus that went into the economy in 2020 and 2021. Now, we're not just talking about cash balance sheets, right? People during 2020 and 2021 bought many long-lasting goods that are not going to need to be replaced for the next 10, maybe even longer years, right? People bought cars, people bought home appliances, furniture, etc. Maybe they changed the tires on their car, etc. So all of these things that people bought, and it was mostly things that people bought in 2020 and 2021, are going to last them a long time. And so if they lose their job or if their income decreases, then they can conserve that cash that they would have had to spend on some of those things that come up, and they can use that to pay down debt. They can use that to still go out and eat. They can use that to still go out and spend money because they're not having to allocate money to these long-lasting goods like a new refrigerator or tires for their car, etc., because so much of that was purchased during the pandemic. Furthermore, the jobless rate at 4% is still low looking at historical standards, and the central bank, its interest rate is up over 5%. So it has a lot of room to decrease interest rates to increase economic activity to try and get people out there spending money again. Furthermore, if you're investing, timing the market is a really difficult thing to do. And so trying to pick and choose when to sell and when to buy is a really difficult task. It would be more prudent to select what you're willing to invest or what you can afford to invest and just allocate every month for the year, right? Just, once at the beginning of the month maybe, or once in the middle of the month, you just allocate and purchase shares of stocks. And you do that for your investing time horizon, whether it be 10 years, 15 years, 30 years, whatever your investment time horizon might be. That would be the most prudent strategy. And situations like this might be an opportunity to allocate maybe a little bit more than you were planning to allocate this month. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.